Okay, great. Let's get started. I'm sure some more people will be trickling in over the next couple minutes, but it is great to see everyone. If I haven't met you, I'm Allie Matroni. I am our client experience director and an advisor at Align, and super happy to be here with all of you. And really excited to be hosting Eric Lansky, president at StoneCastle Cash Management today, who has built not only an impactful cash product that he'll talk about the impact pieces of, but also a cash product that has insurance up to $25 million of cash, which, as we all know, is pretty relevant today after the events of the last few weeks. So you guys are going to love hearing why he built StoneCastle, and Eric Stevenson, our COO, will be on the virtual stage with Eric Lansky to help facilitate the conversation. Please drop any questions you have in the chat, and we'll try to get to them throughout the talk, and then we'll also stop at the 30-minute mark for dialogue and questions at the end of the presentation today. Cool. I will pass it over to the Erics, and I'm going to spotlight you guys so you're taking up the full screen for people.
Great. E squared talks cash. Here we are.
Here we go.
Hey, folks. I'm Eric Stevenson, COO here at Align Impact, and as an operations person, we always have access to cash top of mind for clients. And I think it's interesting to reflect on the impact investing work that we've advanced with our clients. Cash was one of the last asset classes where we found a product we really liked and felt was super impactful and met the operational needs that we needed for clients in terms of the ability to access it, as well as the protection on the FDIC side. We've gotten to know Eric over the last couple of years. StoneCastle FICA for Impact became our preferred cash product. And so today, I think we're just going to chat with you, Eric, and I think start off with, tell us about your journey on how you came to being president of StoneCastle and founding it.
Well, before we go there, first I want to say thank you to everyone for this opportunity. And Allie, you mentioned the 25 million. We actually can do up to 125 million per tax ID. The logic of 25 million, when we roll this out to advisors, and we'll talk about the evolution, we would say, oh, we can do up to $125 million of insurance per tax ID. And every advisor would say, well, I don't have any clients that have 125 million. And then they would say, but it's up to 125 million. And they all got confused. So we just said, okay, it's up to 25 million, but there's more available if anyone has large foundation or endowment type clients or balances. So the background, I've been in the cash space for 25 years. And that in 2008, I was part of the money fund complex. And if we recall, in 2008, one of the money funds ended up breaking the buck. And in 2008, 2009, and 2010, you had all these small community banks also failing. And what happened, people became really concerned about their cash, and all the money went to banks viewed as too big to fail. Sounds pretty, relevant to today as well. So what was happening, all our institutional clients that I used to support were complaining because literally JP Morgan, Citi, and all the big banks were literally charging people to keep their cash at the bank. It was crazy, but they had no other alternative. They were not going to go into a money fund because they ended up losing principal, and no one wanted to do that. And they didn't want to go to a small bank because of the risk of the uninsured deposits. But the logic was that, a local bank can provide, at the time it was 100,000 of FDIC insurance, but today it's 250,000 of insurance per tax ID. And in the US, there's like 6,000 banks. It's pretty crazy. In Europe, there's like 24, and Europe's like 50 or something. But in US, there's 6,000 banks. And the logic was, is there a way to leverage the banking system to get FDIC insurance? And so you can have a single deposit and allocated in increments of less than 250,000 per tax ID. And that's exactly what we ended up building in 2009. Now I see myself big, and big and bold, and I get to see ARC, so that's good. And so the logic was, let's build a product that we can take deposits from our institutional investors and allocate it in increments of less than 250,000. And that was the idea. And StoneCastle was actually very prominent in the community bank sector, started in 2003 by providing something called trust preferred securities, which is a form of capital for community banks. So I teamed up with StoneCastle and said, hey, you have great relationship with community banks. I have these institutional depositors. Let's build a platform which we can build a large FDIC insurance program that's very liquid. Fast forward to today, we have about 23 billion of deposits. We had about 33, but we sold off about a piece of our business that was in the brokerage suite business that had about 10 billion last month. So 23 billion allocated amongst 925 community banks around the country. And yeah, we're privately held. We're backed by Charles Mann Capital Partners, CIBC, about 80 employees based in New York. And all we simply do, it's really simple. We take deposits and allocate it amongst community bank in less than 250,000. We started in the institutional and the corporate world. And then we started getting calls from family offices. So we go into family offices and then advisors, and we supported advisors. And then, most recently kind of in the fintech space. So Square Cash, Acorns, Betterment, that's us as well. We're just really simple in what we do. Allocate deposits to community banks, full transparency, fully liquid.
Hey, that's great. It's great kind of hearing the trends. Folks say things are really built out of frustration, right? So in 2008, you saw something that was obviously frustrating, and maybe that's not the adjective to use, maybe something stronger, and then built something that the market was really looking for. But before we move to the importance of community banks, we hear in the industry, break the buck. Can you tell us what that means? Because that was, widely said across the news in 2008. And then also between FDIC and SIPC, you might get into some alphabet soup there. What are the differences between those two things?
You're very good at this, Eric, by the way. You sound very professional.
I watch a lot of late night television.
Yeah, I feel like I did up the game here. It's very impressive. So break the buck, what it means is that everyone, principal is $1 NAV. So in a money fund, it's pegged at $1. And everyone just always assumes when I put in $1, I'm going to get $1 back. And that was always the logic. A money fund is not insured, but people perceived and expected that if I put $1 in, I'm going to get $1 out. The breaking of the buck is actually went below $1 to 98 cents. But what was more critical for the treasurer and the institutional community was the liquidity. And you saw a little bit about that Silicon Valley Bank, that the potential of the money being frozen. How am I going to do payroll? And people are dependent upon this money being available next day. So there was the breaking of the buck phenomena, but also the fact that the money could be frozen and not accessible. And when you think about cash, you want access to your money. So even today, money funds are great vehicles, really attractive, but they're not insured. They actually have a floating NAV. There was new regulatory reform passed in 2015 as a result of the events in 2008. It took them 7 years, and there's now new reforms that are going to be put into place most likely. So a money fund, if you use a money fund, they're great vehicles, but they're not insured, and you don't have direct underlying ownership of the deposits. You have a percentage of the pool of deposits, whereas when you own a bank deposit, you own those deposits. So yeah, if everyone else wanted the money tomorrow, you can get your money tomorrow. Whereas in a fund, you have to wait for everyone to sell the portfolio and then get allocated out.
Got it. There FDIC kind of bank accounts, you own it. Money market funds, SIPC, and you're in that pool, which hopefully floats at a NAV of $1.
Yeah, I'm watching Ali's body language. We're supposed to be like at 30 minutes here, and I'm talking way too much. So I'm going to try and be
doing great.
We still got some time, and I love that you talked about community banks, because in the news today you hear a lot about, hey, regional banks, right? And we got to make sure that there's not mass consolidation. Then there's this list of like too big to fail. But walk us through, what's the importance or difference between community bank, regional bank, maybe national and too big to fail? Like, what's that spectrum, and why is it important to work with these community banks?
I don't know how many on this call live within small communities, but they are the backbones of local business. They represent maybe 18% of total deposits. There's about 4,600 community banks out of the 5,900 total. So there's many, many, many community banks. Many of them are pretty small, and they are about 60% of all small business lending is from community banks, and 80% of all agricultural loans are from community banks. A community bank is defined as 10 billion in deposits or less, but the vast majority of community banks are $1 billion or lower in balances. So they're absolutely critical in their local communities. The deposits you allocate into a community bank are being reinvested or loaned out within their community, which is really, really important. So many people will say, well, Eric, that's great, but they're small and I'm going to take some risk. I don't want to take that risk. But then I go, aha, but it's FDIC insured. So the money is fully insured. And what's unique about StoneCastle is I don't want to take the headline risk. I don't want to have to call Eric and Allie and say, hey, we had Signature Bank, it failed, but don't worry, we have a backup plan. We had no exposure to Silicon Valley, to SVP, to Silvergate, just any bank with an S. We just try to avoid it. But since our inception in 2009, we have never had a bank where client funds ever fail. which is pretty significant because if you recall in 2009, 2010, like every Friday, you heard about another bank family. So we actually analyze each and every bank in our network and monitor each and every bank so we don't introduce potential headline risk of a bank failure. There's no guarantee it may not happen, but today we've never had a bank with deposits fail. So we are really proud. And if you look at the headlines, on the headline today, I think on Bloomberg, money is fleeing out of community banks, and that's impacting local communities. What we're doing is we're bringing deposits back to local communities, helping small business and helping civic associations as well.
That's great. And so you have this network of community banks. You're not depositing more than $250K across them, and that's how you're able to get this level of insurance on those cash accounts.
Yeah, and it's fully transparent. So when you open an account, literally the way the platform works, I'm answering a question you didn't answer, but I'll answer anyway. It kind of flows. So we have a custodial relationship with US Bank. US Bank is the KYC, AML. So that's the value for community banks. They don't want to handle, all our thousands of clients. So we have an omnibus account that's called FDIC pass-through insurance. So it's more detail, I can provide that to you, but it's a platform that allows us to open up a single account at these community banks. Then I have US Bank do all the KYC, AML, which lessens the load on these community banks. And they just have a single account and a single deposit that's really, really stable. But you as the client, each and every day, you can go into your online account and see each and every bank in which you have exposure. So you know exactly how much you have each and every entity. We do that because A, it looks pretty cool, but B, FDIC insurance is by tax ID, not by point of entry. So we want to ensure that we exclude any bank that may look familiar or you may be banking with already. In the event that bank fails, we want to make sure it's always less than 250,000.
Yeah, and one thing that we loved about that was within your universe of community banks, the CRA, the Community Reinvestment Act, can rate them 1 and 2. And so your FICA for Impact product really targets those types of community banks. Can you talk about what that means to be like CRA rated 1 and 2?
I'm going to answer something that you didn't ask again. So this is probably the last time you'll ever see me do a webinar with Align Impact. But I'm going to talk about the evolution of the Impact product. So we had the federal Secured Cash account that we built in 2009 for institutions. Then we started going to family offices, endowments, and advisors. And then we worked with Clara Miller of the Heron Foundation and an advisor, Tiedemann Advisors at the time. And they really wanted to create an impact type of product that can get monies to banks that were doing more social good or within their communities. And in 2020, we introduced the FICA Impact type product, and that's where that came from. And initially we said, okay, we just want to go to banks that minority-owned MDIs, minority depository institutions. Unfortunately, there's only 44 of those institutions out there, so which is really bad for the system. But we couldn't create a scalable product based upon MDIs. So then we said, okay, how do we expand it to banks that are in communities that have populations that 50% or greater on poverty? How do we support those communities? So that was another element within the FICA Impact. And then the final item we looked at was CRA, which stands for Community Reinvestment Act. How many banks are reinvesting and getting the highest possible rating in terms of doing good within their communities and reinvesting in small business lending and other type of loans for minority-owned businesses. So in our program, we limit the FICA Impact product to banks that are CRA rated 1 and 2, which is outstanding and satisfactory. After that, it goes underlies, satisfactory, and then just really bad. I have the more formal terms, but that's and there's a slide on that as well. But so yeah, we looked at 3 prongs. We looked at, are they an MDI? Are they in populations at 50% or greater of poverty? And then finally, we looked at this highest possible CRA ratings 1 and 2. So that's the FICA Impact, which is a subset of the larger FICA network of banks.
Yeah, we really like that methodology and how you put that together. And frankly, we haven't seen other institutions do that. And speaking of other institutions, other folks may hear of things like the IntraFi network or ICS, Max My Interest, Flourish, other folks that are kind of saying they're doing something similar, right? A fund of funds of cash, if you will, where they're distributed amongst institutions, but you just need to open up one account. What separates StoneCastle from what some of those other folks are doing?
Yeah, they're all great organizations. So IntraFi used to be called Promontory Financial, and they're kind of the 800-pound gorilla. They have a great platform, and what they do, they offer something very similar to us, but it's available via banks, and banks use it as a funding tool. So if you walk into a bank and you have a very large deposit, and you want it all insured, the bank will say, hey, I'm part of the IntraFi network. It used to be called Promontory, and that product was called CDARS and ICS. And a bank will leverage the Promontory IntraFi platform, which is like 3,000 banks, and provide very high levels of FDIC insurance. It really is a wonderful organization. The primary difference is banks use it as a funding tool. So the rate that you earn will be dependent upon that own bank's appetite for deposits. So one month it may be really high, another month it may be low, it may be always low, it may be always high, but every single bank will have a different rate based upon that bank's funding needs. Whereas us, I have nothing else to leverage other than a really great rate and product. So I have to ensure my yield is always going to be competitive, because if it's not competitive, literally my billions of dollars could leave tomorrow. So that's kind of the assurance you have with us, that it's always going to be a competitive rate of return and the FDIC insurance, whereas the IntraFi network is available through banks. You'll have the FDIC insurance, but the yield is really going to be dependent upon that bank's funding needs. We've had a ton of success, so we've invited. Were you going to say something, Eric? I'm sorry. I was going to talk.
No, I was going to say, speaking about your rate, right? I think that's a good point to pause on, right? Because your FICA for advisors rate can be looked at as pretty market rate, pretty aggressive, and folks might ask, hey, how do you achieve this rate, right? I see a CD over here, or I see somebody else offering something similar here. It's not quite at the level that you're offering it. So how do you do that while also kind of maintaining your competitiveness, but also kind of your business?
Sure. So yeah, I didn't talk about the others, but I'll go back to the others and why we're better than the Max and the Flourishes and everyone else. But in terms of the rate, so the average yield on a savings account is like 36 basis points. If you go to FDIC.gov, it'll give you the weekly rates. If you look at the big money center banks, the rates have actually been decreasing, even though the Fed's increasing rates, because they're just seeing an influx of deposits and they don't have to pay anything for this money. So if you have an account at JP, Citi, B of A, US Bank, whatever, you'll probably see a yield of maybe 10 or 15 basis points. It's incredibly low. Our FICA for Advisor product on Monday will be going to 436 basis points, or 4.36%. The FICA impact will be at 371 or 3.71%. So the question I'm always asked is like, okay, Eric, how do you earn 400 basis points above the average, or 350 basis points above the average? It's what risk are you taking? We're taking no risk. All the deposits are placed in overnight money market deposit accounts. The way we get such a nice rate of return is that I'm older. So in the past, when I was growing up, you would go into banks that would give you a lollipop, which was really awesome. But you would always in-branch displays that would say, open up a new checking account and get a rate of 2%. Open up a CD and get an X of Y%. We see that online today, but very infrequently will you see those displays within the branch. The logic is a bank is saying, well, I have some really lazy money. The average relationship with the bank is 17 years old. It's pretty incredible how sticky a relationship with the bank is. And they know that, and they lean into it. And so the average yield is really, really low. So every month, the banks have what's called an ALCO meeting, Asset Liability Committee meeting. And that's when the business bankers will walk in and they'll say, hey, great job. I got $10 million worth of loans coming on board. And then the bank's like, oh, we have to raise 10 million of deposits. In the past, they would do an in-branch display, get in new deposits, but that would cannibalize all the low-paying deposits they have. And banks don't want to do that. So what they now do is they'll call my team and say, hey, Eric, I have $10 million worth of loans coming in. How much do I have to pay for those deposits? So they'll be willing to pay me a premium because they're not cannibalizing their whole book of business. They're going to say, okay, I'll pay you a really high rate for the 10 million, but now I'm still paying a really low rate for my $1 billion here. So that's how we're a go-to funding source, just-in-time funding for 900 plus banks around the country. So they're going to pay me a premium. I'm going to provide really stable, granular deposits, and it works out well for everyone. So that's how that works.
That's great. Well, hey, we are close to the 30-minute mark. So if folks have any questions, you can certainly drop them in to the chat here. But maybe as we wrap up, I'll kind of just sum up why Align ended up going with StoneCastle as its preferred account. And it really comes down to three things. It's protection, accessibility, and impact. So from the protection piece up to $100 to $125 million, right? The fact that you can insure that, because if you look in the news recently, it was all about what are these uninsured deposits, right, at banks. And so as an advisory firm, we want our clients to be insured. We want their cash to be protected so it's there when they need it. The accessibility piece, right? As an operations person, I love that if you submit a request to get your cash by like 3 p.m. in the afternoon, it hits your account the next day by like before 10 a.m. I think is about the time.
Correct.
So the fact that you can access it quickly, it's protected. And then lastly, the impact piece, right? You spoke a lot about the community banks and why it's important to support them, particularly the ones that are CRA rated 1 and 2. But then what we love is that kind of synonymous with impact is transparency. I don't know if you ever invested in like a money market account. It's very tough to understand the transparency of like where your money's showing up, or some of these high yield accounts at like a Marcus or an Ally. You just don't know where your assets are showing up. And there's this old adage, your money never sleeps at night, right? So where is it showing up in the world? And I love the fact that you can log into your StoneCastle account and see each of the institutions that your money's being deposited at. And sometimes I'll go in and Google them just to see where in, which community they're at, to see where my savings is showing up in the world.
Yeah,
so
I had a couple.
Maybe I'll pass it over to you for any final words, and then if folks
Sure.
have questions, we can jump on those.
Yeah, all of you on this call, there literally is 7.7 trillion of uninsured deposits at banks. There's 5 trillion earning no interest. So, obviously Align Impact is a premier firm, and thus they'll have premier clients. I'm confident every single one of you has money at a money center bank that's doing very little social good. Probably is uninsured. If you have more than 250,000, it's definitely uninsured. And the rate of return is really low. Many of you may be part of foundations or sit on nonprofits. They too sit on a lot of cash, and it's so lazy, that money. And you can do some good with the money while earning a greater rate of return and being fully secure. And so that's kind of what we're leaning into. We've always been having this conversation, but it's now that people are waking up and saying, wait a second, I am at risk. I have more than 250,000. Let me secure that. And oh my gosh, I'm earning 10 basis points. I can earn 400 basis points. Why would I not do this? So that's something that we really want to encourage. Look at where the cash is. Look at the associations you're part of, HOAs. There's a lot of cash out there, and you can do a lot of good with that money, help local communities. And yeah, I benefit from that, most definitely, but you are bringing monies to local communities. And right now, those local communities need those deposits because they're leaving at a record pace. And I'm very grateful for this opportunity and obviously the relationship with Align Impact. So thank you.
Thank you.
Awesome. We do actually have a couple questions. Eric, thanks again for being here today, and thanks for all the work that you're doing. It's awesome to hear the passion and how you talk about the work and the way it's impacting local communities. I will pass it over to Rima. I know you have a couple questions top of mind, and I'll let you maybe speak to those.
Yes, thanks, Allie. Eric, it's wonderful to meet you. I'm an impact advisor at Align, so I've recommended StoneCastle to a number of my clients, so it's great to meet you. I had 2 questions, actually. So Eric Stevenson, Align's Eric, had mentioned that there is the ability to see if you were to deposit a certain sum of capital at StoneCastle, what community banks are your deposit supporting. Is there any further reporting that you provide that could then be passed along to clients where you could say, this community bank then supported this entrepreneur of color to start a restaurant or to start a small business, that would bring those stories to life?
Yeah, I tried to do that because, do a case study. Here's your money did this and went to this small business and then supported this. It's a great idea and something we looked at. We looked at geolocating so you can see which communities. It's unfortunate we've just been going through so much growth. We just haven't had a chance to kind of breathe a little bit. Our focus is just superior service to our existing clients, and we haven't done that as of yet. We just haven't had the bandwidth to do it, quite honestly. But it's a phenomenal idea. And you can look at the banks and you can see where they are and what they're doing, but it's not something we've done as of yet.
Okay, that is. And then the second, actually, so clients tend to feel really passionate about the area that they might have grown up in. Is there a way you could select a particular geographic area? Say, I'd like to invest and have a tilt towards the Northeast or the rural South so that they feel a bit more of a personal connection?
Again, really, really great question. And we actually did this program with the state of Ohio. So at the governor of Ohio, they wanted to bring monies from the local public governments, the schools, the fire districts, the libraries, and bring them back to banks in Ohio. Great idea. And we created something called Star Plus, State Treasury Asset Reserve Plus in Ohio. And when we rolled it out, we said, okay, great, we're going to bring these billions of dollars to local banks in Ohio. And Ohio banks were like, I don't want more money. I'm flush with deposits. I don't want to pay I'll take your money, but I'm not going to pay you a good rate of return. So and then we're like, okay, we tried, and we'll give preference to banks in Ohio, but we had to roll it out nationally because, and another great example is a couple of years ago, a lot of money was going to minority banks, and we got calls from clients, and they were saying, institutions, bring monies to Black-owned banks. I don't care what the rate of return is. And we would call these Black-owned banks and say, hey, I got a couple $100 million for you. And they're like, wait, I don't want this money, even at zero, because there's a cost of capital for those banks. They have to pay into the program. So again, great idea.
Yeah.
But the challenge is not every bank may want monies, and there's actually a cost to those deposits within the institution. And then as an advisor, you also want to get a reasonable rate of return. So try to align all of that is really, really challenging.
Thank you. That's really helpful.
Okay, good.
I have one other question. Kai, maybe I'll pass it to you if you want to. Are you here? Your video's off, I know, or I can share.
Oh, yeah. No, I mean, I just had a quick question around with treasury money markets and people flowing into those, right, as those yields are getting compressed. I was curious why those don't, as far as I know, they've never broken the buck, but why is it that they don't when all that money flows in when yields are low and then comes out when yields are high?
It's a good question. I don't know the answer. They are on the pressure. But what they do is when you look at there's something called a WAM, or weighted average maturity. And so the portfolio managers are pretty seasoned. So they can say, hey, I'm going to keep this paper really, really short. And so that, they're not going out more than the average life is less than 30 days or less than 60 days. So what they'll do is they'll keep the portfolio really short. So if they expect volatility, it'll be like literally 1 to 3 to 5 to 7 day treasuries. And so you can be really fluid with it. And therefore you avoid that breaking of the buck versus, like Silicon Valley, they had longer dated treasuries. And that's how they got into trouble. People wanted their money out. They're like, oh no, I have to sell these longer term securities at a loss. And that was the big fear that happened in the banking system. That's why the Fed stepped in to do something called mark to market that said, hey, all the banks that you could probably have losses on your portfolio because you all went long on treasuries. Long means long weighted maturities. So they try to alleviate that by saying, hey, even if you're at a loss, I'll still give you par on it at $1, value. So I can't answer it fully, but my guess is because the portfolio managers are really smart and they stayed really short. So if there's volatility, you're not going to take any loss like they did at Silicon Valley Bank.
Makes sense. Thank you.
Of course.
I have a couple other anonymous questions that have come in through the tip line. One is, are there any new products or initiatives in the works for StoneCastle? And what does StoneCastle look like in 5 years?
Any other products? No. Everyone wants to do new products, but I'm like, there's 7.7 trillion of uninsured deposits out there. Let's just stick to our data and keep it really simple. And so that's been my focus. We are always looking and discussing things, but I'm pushing back on that as much as possible, just keeping it really simple and straightforward and looking to expand our bank network. That's our biggest priority right now. Getting more monies to community banks and providing higher levels of FDIC insurance to our depositors. 5 years, I try to use the Buddhist philosophy of being focused on the present moment. So I'm just focused on the present moment, having great partners like Align and working with their clients. And I have no idea what tomorrow may bring, but we just have a really solid infrastructure, solid business model, and hopefully we'll continue to grow and expand.
Awesome. One other clarifying question. Can you one more time kind of break down the difference between FICA for advisors and FICA for impact?
Sure.
I've gotten a couple questions about that.
Yeah, and then we can give a little sheet that breaks that down as well. But
and just to formally say what the acronym is. So FICA is an acronym for Federally Insured cash account.
Yes. Eric learned that yesterday, so that's why he's showing off now.
No, I knew what it meant. I didn't know if it was FICA or FICA, you know?
Yeah, okay. I'm sorry. Yeah, so we have a universe of banks, so it's 925 banks that they're all well-capitalized institutions. The vast majority are community banks in general. And then we say, okay, how do we have more impact with the deposits? I want to go not only to community banks, but I want to go to community banks that either are minority owned and are really beyond their peers in terms of community reinvesting and are within populations of 50% or greater in poverty. So it's a subset of the program, but I would really say, I love the impact product. It's phenomenal and it does a lot of social good, but the FICA product itself does more social good than a money fund or a money center bank. And it is bringing monies to communities around the country as well. So they're both doing good. The impact is a little better, more social good, but you're also taking a discount in terms of your performance.
And at the FICA for Advisors, or FICA for Impact is a subset, like Eric said, of FICA for Advisors. And that pool makes up about 46% of the overall FICA for Advisors pool. So I think there are some clients who like to say, hey, I want 100% allocated to FICA for Impact and okay with that rate. And others who might say, hey, if I'm looking to achieve, let's call it 50% impact within this pool, maybe I look at that FICA for Advisors level because they're looking for that yield.
Sure.
Awesome.
Any other questions?
Yeah, pass it over to Steph. And hey,
yes, you just have a question over here. So I love the product and the transparency. Any chance you'll be rolling out an iPhone app for StoneCastle?
That's another request we get. Yeah, people want to do it. Our tech people want to do the apps as well. It's just, it will be something. So in the future, I don't want to think about the future, but the future is something we can definitely focus on, and I plan us to do. Right? It sounds like right now it's just dealing with the volume of business and making sure the platform and the technology and the support is being provided.
Got it.
awesome. Maybe one more question. Paige, did you want to jump in?
Yeah, sure. So I was thinking about, you were saying earlier how there's a finite number of banks. So for StoneCastle, does that mean there's a finite ability to grow and scale?
There's always a finite, but in terms of, when you say the banks may take its capacity at the banks. So right now, let's say we're at 22 billion. I have another $30 billion of capacity within my 900 banks because I only will bring 3 to 5% of the bank's total deposits to institutions. I never want a bank to be so reliant on us that they're not diversified. So if a bank, I'll use the example, if it's a $100 million bank, I'm only going to give them $3 to $5 million. They may pay, they say, Eric, I want more. I'm like, no, because this is a liquid account and I may have to pull out my money and I don't want to collapse your bank in your local community. So we can grow exponentially by bringing in a new bank. A new bank may say, okay, here's 10 million of capacity. 10 million divided by 250,000 is a lot of additional clients that I can support. So it is, unlike a money fund, I don't have an unlimited level of securities that I can purchase. So there is finite, but I can, 50, 75 billion, $100 billion is not out of the realm of something that we can do in a reasonable amount of time.
Great question, everyone. Any other questions before we wrap up? All right. Well, this has been awesome. Both Erics, thank you so much for the discussion. Super excited to continue to have conversations about StoneCastle from the advisor perspective and excited about the work you're doing. For everyone on the call, we will send out a detailed deck on StoneCastle and both FICA products. So all the information will be in that deck and feel free to reach out with any more questions that come up.
Perfect.
Thank you for
Eric, and I'll send you an updated deck because we'll have the higher rates. So we'll get you a new deck with the most recent yields.
Perfect. Thanks, Eric.
Awesome.
Thanks, everyone.
Hope everyone has a wonderful day.
Thank you.
Thank you for this opportunity.